Is the United States barreling headfirst into a recession in 2025? This is a question that I get asked a lot because it's an important question for the average American because of how much it would affect us all. And it's a question that has been put under a microscope recently because of a few things. One of those, yes, being Donald Trump's on again, off again tariff policy, which causes chaos in the business sector, but also because of the stock market, which hasn't really had a great last couple of weeks. In fact, the S&P 500 is sitting at 6-month lows. And of course, Donald Trump refused to rule out the possibility of a recession in 2025. With that said, if we're going to try to estimate the probability of a recession, we need to follow the data, which is exactly what we're going to do in this video. So as always, my name is Derek, and I got my degree in finance, so you don't have to. Let's dive right in. So there are really three major areas that we need to look at when talking about the possibility of a recession. And of course, this does not include a black swan event. A black swan event, by definition, is unpredictable, so we'll leave that out. But the three main areas are Federal Reserve monetary policy, unemployment, and consumer spending. Notice how I didn't say the president, because while the president is a very important figure, both politically and economically, when it comes to the chances of recession, while he or she has a tremendous amount of influence, there are other things that directly matter more, at least when it comes to trying to predict a recession. And the first, and probably the most important indicator, is employment. Or unemployment for that matter. When you see the unemployment rate start to tick up, it's a warning that potentially slower economic times are ahead. And when we look at the unemployment rate, it is ticking up. Most recently, it's sitting at 4.1%, which is higher than a few months ago, but it seems to be holding steady there. Another thing that we have to understand is that historically, 4% is quite low. And we also have to ask ourselves why. Why is the unemployment rate slightly ticking up? And of course, the answer is not so much business hardship, but the Federal Reserve's monetary policy. Over the last few years, the Federal Reserve has kept the FFR, which is the federal funds rate, which dictates short-term borrowing costs, relatively high. And that is to fight the inflation that we have all been feeling for the last few years. And of course, higher interest rates is a drag on the economy and of course on hiring and thus unemployment. With that said, two main things matter here. One is that the Fed has already pivoted. It has already begun the process of bringing down interest rates. And while it has paused recently, and the next Federal Reserve meeting, which is next week, has a 99% chance on the CME Fed Watch tool, which tracks the likelihood of an interest rate cut, that there will not be an interest rate cut then, it still doesn't change the fact that the Federal Reserve has pivoted, and it will most likely continue, although slowly, to lower interest rates. This will only help the overall economy. And most recently, the Federal Reserve itself has predicted that by the end of this year, the unemployment rate will be at 4.3%. Now, if it's slightly higher or slightly lower, the fact of the matter is unemployment has remained relatively low even in the face of high interest rates. And I know some people are going to say historically 4, 5, even 6% on the federal funds rate is not high. I understand that. But when we look at recent history, it is. And this most recent economic cycle has grown directly because of very cheap money. So relative to that, it is high. And in fact, one of the two main reasons that the Federal Reserve has slowed down its interest rate cuts is because of how resilient the job market has been. The other reason, of course, is sticky inflation that doesn't seem to be budging below around 3%. But the point is, the Federal Reserve has felt confident keeping its rate higher than it otherwise would be at this point because of the resilient job market. All right, and since we've slightly already touched on it, the next major area to look at is the Federal Reserve's monetary policy. Because again, all else being equal, higher interest rates is a drag on the economy and lower interest rates is a boost on the economy. And here again, the cards look decent for avoiding a recession. And that's because, like I said, the Federal Reserve is already well on its path to cutting interest rates. Now, they are cutting them much slower slower than expected and much slower than they said they would cut them, but they are continuing that path. And unless we get something major like a recession, that is unlikely to change, which of course, almost like a vice grip, as this is loosened, will benefit the economy. Why? Well, because cheaper money causes economic growth. It allows cheaper borrowing, which allows consumers to spend more on credit, and it also allows businesses to invest in research and development and to borrow to grow because that money is less expensive. And now the third major area that we need to look at, and that is consumer spending. The US economy is a service-based, consumer-based economy, which means most of our GDP comes from services, but the consumer base also fuels a lot of that growth. So when we look at this area, if we see a major drop or pullback in consumer spending, it means two things. One, it means a higher chance that GDP starts to lower. And secondly, it signifies less consumer confidence in the economy, because when people perceive trouble around the corner, they're going to save more money. And when we look at this area, consumers have remained quite resilient in their spending, even in the face of a slightly increasing unemployment rate, and even in the face of historically, at least recently, historically high interest rates. And really, to start the snowball that is a recession, we need 2 consecutive quarters of negative GDP growth, at least classically. And in order for GDP growth to turn negative, you need consumers to let off on spending. So while we have seen a little bit of hesitation, consumer spending in general has remained strong. So what does this mean? Well, you're probably saying, well, this means that you don't think that there's going to be a recession. And yes, you would be right. I don't think that the chance of a true recession is likely or high in 2025. But that doesn't mean that things are all roses and butterflies. In fact, quite the opposite. Unfortunately, what I think is going to happen in 2025 is more of the same, which is not quite a recession, but an environment that might as well be a recession for the average American because of how it feels. And that has to do, once again, with prices. More specifically, prices to wages. The overarching problem for the last 4 to 5 years is this massive discrepancy between prices and wages. And until that switches, until we have strong wage growth and people feel strong in regards or in comparison to prices, we're going to live and exist in an environment that isn't quite a recession, but it might as well be because the average American doesn't feel financially secure. And that is specifically because of how expensive things have gotten compared or relative to what the average American makes. And yes, I know that wages are outpacing inflation, at least recently. The problem is we need wages to outpace inflation for many, many months, if not years, to catch up and surpass the damage that these high prices have done. Because remember, we're not going to get lower prices, even in a recession. If you look back at the 2008 Great Recession, which was basically the second largest financial crisis of our history, there was roughly a 2% or so GDP negative growth, which isn't a lot, and it's not enough to undo the massively higher prices that we've gotten over the last few years. So even if a recession did happen, the prices that we have are basically here to stay, which means the only way to get ourselves out of this uncomfortable economic situation is for wages to continue higher and to eventually surpass all the inflation in prices that have happened over the last few years. And unfortunately, that's just not going to happen in 2025. It's probably not going to happen in 2026 either, or maybe even 2027, because it takes a lot of consecutive months of positive wage growth that outpaces inflation for us to feel the relief. So while I don't think that a recession in 2025 is likely, and I would bet that there is a higher probability that we don't have a recession. Unfortunately, we're also going to have a pretty difficult economic environment for the average person, and that's because of prices. I hope this video was informative, even though it may have been a little bit somber. If it was informative, please consider subscribing. It helps the channel tremendously. And if you like personal finance, world economics, and investing broken down simply, you are in the right place because that's all we do. So with that said, I hope you have a fantastic rest of your day, and I will see you in the next one.